If you do the correlation between Bitcoin and gold, their returns, since 2019, and I put this in my New Year's letter. You can see the matrix there if you'd like. The correlation has been 0.14. One is perfect correlation, and here we are at 0.14, very low, almost no correlation. So that is very important to understand. What you can also see here, though, is gold tends to precede a big move in Bitcoin. You can see the circles there, and we'd have a gigantic circle around what has happened recently. And so maybe that will happen again.
When people talk about Bitcoin and gold, they love acting like they're twins, two reliable hedges marching side by side through every crisis. And honestly, I get why. In a market this brutally bearish, it's comforting to imagine clear, predictable lifelines. But if you actually zoom out and look at how these two behave, the picture gets way more interesting and way less tidy. Bitcoin is the loud, volatile disruptor. Gold is the slow, stubborn veteran. Treating them as interchangeable kind of misses the whole story, one rooted in old-school finance and the other in a completely new digital conviction. That's why I appreciate how Cathie Wood breaks it down. She doesn't buy the slogan that Bitcoin is digital gold. She points to the data. Since 2019, their correlation has been shockingly low, almost irrelevant, and the pattern she highlights is even more fascinating. Gold tends to move first. Capital dips its toes into safety, and then flows into Bitcoin when investors feel braver. Right now, that detail matters more than ever. Gold has been making noise, real, undeniable strength, while the crypto market bleeds and sentiment collapses. And honestly, I agree with her read. In moments like this, markets often hint before they scream. Gold flashing green in a sea of red doesn't feel random. It feels like the early pages of a familiar script. So the real question is, if gold is leading again, are we about to witness another rotation into Bitcoin? Or has this bear market rewritten the rules? Let's take you back to Cathie Wood as she breaks down exactly what this market is signaling beneath all the bearish noise. Don't forget to like, subscribe, and enable notifications for additional in-depth content. Thanks for joining us again. Enjoy the rest of the video.
Crypto. Here, I think the disconnect, and this is also from Big Ideas, is, hey, look at what the gold price has done in the last few years, and look at what's happened to Bitcoin. Now, this is a log chart, so you can see gold has had a massive move to the upside. This chart ends at the end of 25, and of course, I think last night we got down to roughly $60,000 in Bitcoin. So really cut in half since its peak in October. What is going on here? Isn't Bitcoin supposed to be digital gold? If it's digital gold, why isn't it behaving like gold? I cannot tell you how many bear stories I've heard about Bitcoin in the last few weeks, last few months. And just go on to X and you'll find all kinds of reasons why you must sell Bitcoin. And these are the periods that are kind of interesting. We post our trading at the end of every day, and you'll see that we had been nibbling at our crypto-exposed stocks. We didn't know how far this was going to go. And maybe it's not over, not promising that. But there was so much negative sentiment that I felt, okay, we need to leg in and lean into this. If our research is correct, that this Bitcoin is 3 revolutions in one. It's a global, digital, private, very important, rules-based, even more important, monetary system. And that's a very big idea. The second revolution is, it is a technology. It's a new technology. It's really adding another layer, I would say, to the internet, so that we have native currencies native to the internet that will be able to handle agentic commerce and other such agentic movements taking place out there. That's a very big idea. And then, and it won't be, of course, just Bitcoin. It'll be Ether, importantly Ether, Solana, maybe Hyperliquid. We shall see. But what's interesting about this period is the big three have been identified. And those are Bitcoin, Ether, and Solana. You know, the worry historically has been, how many of these things are there going to be? Is this going to be a very fragmented situation? And we're learning we're learning who the big winners are going to be, who the big winners are. And I think that's a very important. And then the third revolution is, this is a new asset class. Bitcoin is leading the way. It is the most secure of all the cryptocurrencies out there, backed by the largest computer network in the world. And so really an anchor to an asset allocator looking to move into this new world. And why would an asset allocator do that? Well, if we're right, and well, it's a fact that at least over the last 5 years, the correlations have been the correlation has been as low as 0.14. The key to successful diversification for asset allocators is adding new assets with very low correlation to all of the other assets in the ecosystem. And this one qualifies. Why do they want that? It is because with that low correlation, introducing it, risk-adjusted returns go up over time. And so I do think institutions are serious about this new asset class. They may have been reticent to move in because they were hearing about the four-year cycle, and lo and behold, and I'll hats off to Chris Berniski, who has been very right in calling for, whether it's the four-year cycle or whatever, just this downdraft. And so it's closing in on the low point that many technical analysts are suggesting as the place where it should stop. These are very volatile moments at or near the bottom, but we usually do look back and say, wow, I wish I had caught that low. This V-shaped recovery has been quite significant. Not promising. I want to make sure that there are no promises here, but it does seem like the stars are aligning. So what has been the biggest bugaboo as it relates to Bitcoin, or the worry that we've heard about more than anything else in the last few weeks? Because it's all about quantum computing. The last few weeks have been, lots of stories about quantum computing, and I would say the large shift in Bitcoin, the OGs selling, or just shifting wallets to more quantum-resistant wallets. So I think that's really caused a lot of concern. And here's Michael Saylor's answer, he was very reasonable last night in his discussion around quantum. He doesn't think it's going to be an issue for 10 years or more, but he said, here's what we're doing in terms of our commitment to Bitcoin security. And so you can see some of those moves now. But I also wanted to show our research. Again, this is out of Big Ideas. And this is when the quantum controversy had quieted down last year as it relates to Bitcoin. So Brett Winton, as chief futurist, has a big focus on quantum because we can't miss the next big thing. It's all we do is disruptive innovation. And here I thought was a compelling analysis based on what has happened with quantum computing so far. And Google really leading the charge, that little black line on that chart. So you can see that it has been able to double the number of qubits over 4 years, which is slower than Moore's law in the semiconductor space. And of course, there is an error rate consideration, lowering that as well over 4 years.
Gold has been moving like it knows something the rest of the market doesn't, while Bitcoin has basically been thrown into the bargain bin. And honestly, that contrast is exactly why people are scratching their heads. But here's the twist. The gap is the signal. These two don't move in sync, and they never really have. Gold tends to step out first, almost like it's testing the environment, and then Bitcoin, late to the party as usual, comes in swinging once the coast looks clearer. And when you mix that with what we're seeing right now, extreme pessimism, confidence evaporating, and smart money quietly scooping up positions, it starts looking like one of those setups that only makes sense after the reversal is already underway. What's wild is that the loudest headlines, quantum fear, apocalyptic narratives, crypto is dead chance, aren't even the real story. Quantum threats? Decades away. What we're actually watching is long-term holders adjusting, not abandoning ship. This is repositioning, not panic. Let's take you back to Cathie Wood to hear more from her.
So if Google does not pick up speed, the red line tells you how long it will take Google and quantum computing to really threaten Bitcoin, the Bitcoin blockchain as we know it now. So we go into the 2060s there. Now, if you make the assumption that Google is going to pick up the pace, and that's an interesting assumption because typically we learn a lot in the early years of a new technology. You know, how quickly are the units increasing and driving costs down? That's the learning curve associated with new technologies. But let's assume it does pick up the pace, doubles the pace to Moore's law. Okay, then we have a problem in the mid-40s. So I don't want to make light of it. I do think it has caused movement among Bitcoin between wallets, between and among wallets. Are they leaving the crypto ecosystem? Some say yes. Maybe they're diversifying into other crypto assets as the DeFi ecosystem evolves here. I don't know how likely that is because these are Bitcoin OGs. They've been there forever. So we'll see. Maybe they're diversifying because they were hodlers. And now they're 10, 15 years older and they have families and, you know, their risk profiles have gone down. They should diversify. Any financial advisor would say so. We'll find out, but I thought Brett added some good perspective here. So here you can see the liquidity index. This is Dan Rodriguez's chart. And you'll see liquidity dropped to a low level in November. Why was that? It was the government shutdown. And we thought, okay, this is going to be short term. Liquidity will pick back up and the market will take off again. And that is what happened. But recently you can see that it is back down. And what's happening there? Well, we had the threat of the shutdown, and now we actually have the shutdown, partial shutdown, and in mid-February, I think it might be February 14th, there's going to be a vote around the Department of Homeland Security's budgeting, and it may shut down more completely then. So I do think there is somewhat of a liquidity drain. And then the other thing that's happening is the Fed was supposed to stop quantitative tightening in early December, and it did for the most part. But its provision of liquidity to the system is lower than many analysts expected. In recent days, it has started to pick up. You're seeing some of that now. And I do think the Fed and the Treasury are beginning to respond to what has happened to the financial markets. This administration does believe that the financial markets provide important signals. And so they are probably assessing the liquidity conditions out there and moving accordingly. So I do think this one is probably moving in the other direction. Here you go. You've seen this chart many times, metals to gold. We've learned something very important, and I'll spend more time on this in next week. But what surprised me, and this is up to date, is with the fall off in gold recently, that the metals to gold ratio has not picked up. That is really surprising to us. We've learned in recent weeks why the Treasury yield has been levitated. This very tight correlation between the metals to gold ratio and the Treasury yield broke down starting with the Fed tightening. And, it's still gaping wide. We're learning and believing more and more that this is the yen carry trade unwind. What are they doing? Selling treasuries and buying Japanese bonds. Why? Because Japanese interest rates have gone up. And so the U.S. Treasury bill is less interesting. It's still above the short-term rates in Japan, but less so, much less so, actually, and could continue in that direction if the current prime minister is, she just called a snap election. I think it's for this weekend. And if she gets a larger majority, she will amp fiscal spending even higher, and that will probably take their interest rates higher. Nonetheless, the purple side is puzzling. I think it has to do with deflation coming out of China and impacting the global ecosystem. Sure, we've seen some metals go up, but this ratio going down even further as gold goes down is most surprising. Here, I just want to go through, I presented this chart at the last in the know, so we'll just give you a sense of how crazy it got a couple of weeks ago, gold going parabolic. As a percent of M2, and many people pushed back on our use of U.S. M2. You can't get global M2 back into the 20s, and the U.S. still is the reserve currency. I don't think the message would be much different with a global M2. So you can see it hit an all-time high, higher than the Great Depression at 1.6 versus 1.76 versus 1.71 in the Great Depression in the 20s. Today, it's at 1.54. So we do think the bloom is off the rose, but it's still at very extended levels. And we wouldn't be surprised if gold continued to come down to Bitcoin's benefit. We shall see. And also, I think Bitcoin has been hurt by all of the funds flowing into AI. That became the interesting investment opportunity, and that one has become a little shaky. So I think, these three, gold, AI, and Bitcoin, are interrelated in that way.
Bitcoin's drop to $60,000 rattled confidence at exactly the wrong moment. On paper, the setup looks bullish. ETFs are live, institutions are circling, and regulation is moving toward clarity. Yet price action told a different story, with sharp volatility reminding everyone that Bitcoin still refuses to behave neatly. That contradiction is the point. This market is not broken, it is transitional. Anthony Scaramucci framed the move as a normal correction for an asset still early in its global adoption curve. Bitcoin is no longer a fringe experiment, but it is not yet a fully absorbed macro asset either. That middle ground is where volatility thrives. Younger investors dominate Bitcoin ownership, while older capital still leans toward gold and silver. That helps explain why gold ran first while Bitcoin lagged, even though long-term conviction remains intact. Regulatory uncertainty only adds fuel to the swings, keeping cautious institutions on the sidelines despite ETFs providing a growing support base. This perspective fits cleanly with what Cathie Wood has emphasized. Bitcoin is not just digital gold, and it was never meant to move in lockstep with it. Low correlation is a feature, not a flaw. Historically, gold often moves first, with Bitcoin following later in more explosive fashion. Periods of extreme fear, like now, tend to cluster near important inflection points rather than long-term tops. What looks like chaos is really price discovery. Volatility, fear, and skepticism are the toll paid for owning an asset that sits at the intersection of money, technology, and a new asset class still finding its place. As we wrap up, do you still see Bitcoin as digital gold, or is it becoming something entirely different? Let us know your thoughts in the comments below. Share this video and hit the like button. Thanks for watching, and don't forget to like and subscribe.